I'd just like to introduce you to my clients. This is Alexander Cousley, who is the Senior Investment Strategist Analyst for the Asia Pacific for Russell Investments. As we've previously have had client functions where Russell's presented, it's going to be uncertain whether we'll be able to do it this year because of COVID-19. So I thought it would be good for us to get a perspective where Russell is seeing the world of investments right now. I met Alex through a webinar that Russell was conducting internationally, and I was quite taken by how he presented and provided information. And being a homegrown boy in Perth, Sydney, I'm in Perth, I thought it'd be good that Alex could present it with an Australian accent, which is nice. And being Russell, local person looking after the Asia Pacific as a analyst, I thought who better place would be for Alex to answer some of my questions. So Alex, starting off with Russell, how they're looking at the international market for investment right now?
Sure, thanks Peter, and thanks for your time. In general, like the way that we're viewing the world right now is that we think that it's a favorable environment for growth assets and risk assets. And I think the best way to really show this would be to go through the way that we think about markets on a tactical horizon. And so I just got a couple of slides to illustrate the way that we think about and analyze risk markets in general. So we have a three-prong approach to thinking about tactical investment decisions, and that is cycle, valuation, and sentiment. And so what we're trying to gauge is, across those three factors, where we are sitting and where the skew is for each asset class. So when we talk about the cycle, there are things like where we are in the economic cycle, what central banks are doing, what governments are doing, where we are in the earnings cycle. When we talk about valuation, we're looking at trying to estimate return potentials. What we can think of as like almost equilibrium returns. And then finally, and this is the thing that really was very important for us through the COVID volatility, was sentiment. So getting in a feel for how the market is positioned, how, whether we're seeing signs of greed, whether we're seeing signs of euphoria, because that tends to be quite a good indicator of a turning point in markets. So as I mentioned, we do have a positive view on risk assets in general. And there are two really major factors on the cycle side of things that we think that. So firstly, we are very early in an economic cycle. We've gone through a very short but very sharp recession globally. And what this means is that globally, the economy is going to be able to grow and create low inflationary growth, which tends to be quite a good environment for equity markets. So the charts in front of you come from our US strategist, Paul Adelman, that looks at where we are in business cycles by the output gap, so the percent or how far away from potential GDP the US economy is, and then how equity markets have performed. And you can see that we have just entered the recovery phase, the light green, and that is very favorable for equity markets historically, and we don't have any reason to think that won't be the case this time. We move to valuations. There has been a huge rebound in markets clearly. At the very depths of what we saw through March, we basically had the US equity market just dip below fair value because it was very expensive, and I'm sure a lot of your clients will have heard our view on US equity market leading into this, that it was expensive. It got down to just below fair value in our opinion, while outside of the US, we saw equity markets extremely cheap. UK equity markets still looks very cheap in our opinion. Importantly, on a global basis, we're seeing that equity markets are probably fair priced to slightly expensive. So it's not really a barrier for further performance in our opinion. And then on sentiment, one of the developments that we've done over the last 2 years is to build what we call a composite contrarian indicator. It's quite a mouthful, but what it basically tries to gauge is we have a number of indicators. So there's about 16 different variables in this indicator. And we're trying to get signs of panic. We're trying to find signs of euphoria. And you can see in March how that grey line just popped straight above the panic sign. And that was an indication to us to start moving into risk assets and that the skew was starting to become attractive. And that paid off quite well.
Okay, so with regards to the Australia, how would you see the Australian economy holding up during these times? And where are we seeing it progressing from this point on?
Yeah, so I think the big differentiator between Australia and most of the, a lot of the rest of the world really rests on how the household was coming into this. So if you looked in the United States, for example, the consumer was in a pretty good position heading into this COVID experience. In comparison, in Australia, with the high levels of household debt, we were seeing that even with the tax cuts and the interest rate cuts from last year, the consumer really wasn't putting that money into spending and instead was just continuing to pay down debt. So we're seeing housing equity payments continuing. I think that is going to remain a bit of a concern for the recovery. We still, have a bit of a way to go before the household balance sheet looks a bit more healthy. And then I think the other two things in a more shorter term is really around tourism and the students and the speed with which they're able to come back. And that's really going to rest very dependently on how the vaccine for COVID-19 develops, where we are seeing a promising developments, but it still seems like it could be a couple of months at the very best.
And so how's all this debt going to be paid back by the government? I mean, it's a record amount of debt that's taking on.
Yeah, I mean, this is not just an Australian question, this is a question that we're getting globally. I think the really important thing, and it's probably the big difference in terms of the zeitgeist of economists from the GFC to today. If you think back to the GFC, a lot of the focus was on trying to move back towards austerity and pay back some of that debt. And the economics profession, I think politically, the political class, have moved to looking at the relationship between growth and interest rates. And so when you think about in Australia, the government can go out and borrow for 10 years at 75 basis points. As long as you can grow the economy on a nominal basis by more than 75 basis points, debt to GDP is naturally going to decline. And so I think that as long as we have that, the debt sustainability worries are not as big a concern as they were coming out of the GFC. And then, of course, you have, there's increasing amounts of talk about the idea that that governments are going to move towards modern monetary theory, where the central bank just monetizes any of the debt, which isn't our base case, but it certainly seems to be getting a lot more traction.
So with debt, when the debts come to maturity and they've got to be paid back, is that the time we're going to see interest rates rise? So it'll attract more money to roll over, recycle the debt until it's ultimately be paid down?
Potentially. I think the more important thing is that we just see it very difficult for interest rates to move higher in the next 2 or 3 years, particularly on like the central bank cash rates. I think the Reserve Bank of Australia and the Federal Reserve in the United States won't be raising rates for at least 2 or 3 years, because even though we have this huge amount of money that's flowing through the system, as that chart earlier showed, there is a big gap between what economies could potentially be producing and what they are producing. And so as long as that gap is still there, it's really hard to see inflationary impulse move higher. And without that, I think central banks are going to remain pretty hesitant. And on top of that, in the United States, they've moved towards average inflation targeting, which is similar to what the Reserve Bank here do, where rather than the Fed looking at 2%, and when they get close to that starting to raise rates, they're really saying we're going to wait and we're going to let the interest rate, the inflation rate overshoot that. And so you let the economy run a little bit hotter for a little bit longer.
Okay, obviously the importance of not trying to pick the particular investment sectors and the markets, because there's so many variables out there, political risk, we don't know what happened to the US election. We don't know if there's going to be any other geopolitical issues with China and Taiwan and those sort of things. So just explain why, Alex, why Russell go to the length they do in having a multi-sector, multi-style approach to the investment portfolios that that Russell develops.
Sure. So I think, Peter, you've done quite a nice job of, really showing how many variables are out there and how many things can impact performance. And here at Russell, we really do believe that ensuring that you have a very well diversified portfolio is extremely important. And on top of that, we with the multi-manager is that we want to get the best of breeds. We want to have the best of breed managers giving us exposure to particular asset classes that our research team and the strategists and the portfolio managers, the asset classes that they think are attractive. we get that, but then we also want to make sure that we're getting the best managers to give us the best exposure to a given asset class, or just to a given exposure that we're looking for. And so we spend a lot of time really focusing on how the risk, where the risks in the portfolio are, what we're exposed to, making sure that we have those diversification benefits in play.
I noticed in a lot of the multi-sector managers, you've got a build-up of cash in the cash account, and presumably that's really positioning the funds to take on new investments when they see new opportunities that present, rather than having to sell down existing investments at possibly a loss to buy something better. Is that sort of the approach Russell is taking right now?
Yeah, that's part of it. We also went through COVID. We were just making sure that we had liquidity available for any withdrawals. But I think, yeah, one of our things is we do like to have a little bit of that dry powder ready, so that when we do see really good opportunities, we can really be quite aggressive in pursuing those opportunities without having, as you said, moving money out of one asset class into another.
One of the things, of course, is that when the global financial crisis hit, a lot of people were saying, why don't you just take all your money out, cash it out, and go into some sort of hold it for a while and wait till the market recovers. Now, some people may have done that, and they may have been successful in not losing as much initially, but in the time scale of actually over the medium-term period, what's the risk associated with people trying to guess the market like that, Alex, and missing out on recoveries when we really don't know when that will occur?
The risks are quite large. There's been a number of studies, and Russell did one a couple of years ago looking at, what you miss out, because those very big trading days, how much that cost you if you weren't in the market. So, I think it's really important that if you have the ability to look at a medium-term horizon, always keep that in mind. Moving to cash might seem like the right idea, but if you have a medium-term mindset and time frame, it really doesn't make sense to be moving completely into cash at any given point in time. And I think that the rebound that we've seen in equity markets, particularly in the United States, I don't think many would have predicted to be as strong and as quickly as it's been, but it does show the difficulties of timing the market, or perfectly timing the market, and the risks of if you do move into cash and you miss that rebound, just how quickly it can happen.
Now, we've seen the technology stocks been driving the market in the US for some time, and now they've had a bit of a pullback because the valuations are seeing way over to what they're actually generating in income. I mean, Tesla cars is a perfect example. The value of their motor vehicles, and they're making less motor vehicles than Toyota, yet they, not making the profit that Toyota's making. So could you sort of give the parallels of how this, looking at the quality companies that are producing and sustainability and their forecast growth and this environment, tell us how Russell deals with those sort of those situations, and trying to analyse which is the place to be and to avoid.
So we have our own internal research that we do. We don't buy given securities, but we do look at styles, we look at sectors, and try to understand what the macro drivers of those are. But this really comes back to an earlier question that we discussed around getting the best of breed managers, and we get the best insights and the best positioning and the best opportunities on a stock by stock basis through the managers that we select, that we have very high conviction in.
A lot of people are thinking about elections right now. The US election's coming up. Some people think, they would like to see a change in the US administration, but others saying we do. That might cause a shock to the markets, because the tax cuts and the other things that the current administration has brought into the US economy has actually driven a lot of the growth and favourability, and a change of administration might impact on that and to reverse some of that growth. How's Russell approaching that at this stage?
So, elections are so difficult to pick, and I feel like this point is even more so. We were just looking at election odds and polling, and everything is all over the place. The couple of the key things that we're focused on is that, it seems like it's really close, but in US politics, or any political race for that matter, even just a month, it feels like a lifetime. What we're focused on in terms of the actual implications of a change in administration is, as you correctly noted, the change in tax rates. The Democrats have pushed for taking back some of that Tax Cuts and Jobs Act that President Trump enacted. Importantly, it's not going to be the entire thing taken back, given the fragile nature of the US economy as it's very early in the recovery. And I think the other thing that doesn't get as mentioned is, a Democrat president and administration is going to provide more fiscal stimulus. So the headline package that is getting discussed, if they were to win the Senate, is an infrastructure package, and so some of that spending would offset some of the impact that comes from the top corporate tax cut rise.
So there's a lot of this noise out there in the media about not just only the US election, but a lot of other things that are going on in the world. Nothing changes, does it? There's always going to be this sense of uncertainty and volatility, and I guess that's where professional fund managers, they keep their heads and they're not being getting caught up in this either euphoria or this fear factor. They operate on the fundamentals and help to ride over those storms and see through into the future how things should come back once the markets get back into a more fundamental position. Is that sort of your mantra as well?
Yeah, certainly. And I think the other thing that's really important is just having a very diversified portfolio. So you don't, whilst you do see some of those drawdowns and some of those, epic runs, but you don't see to the extent that you would have if you had an undiversified or a single exposure. And so I think having the best of breed managers, a very strong research team internally at Russell, and that, very strong emphasis on diversification. And that's what helps you get through the day-to-day and the volatility and the uncertainty, knowing that you have these three fundamental pillars that ensure that portfolios have the smoothest path towards the goal.
So to give us a perspective for the listeners of this video, Alex, how many analysts and fund managers does Russell employ around the world?
So we have within Russell, the investment division, there is 300, 400 people off the top of my head. Mm-hmm. And that is split across research, the portfolio management team, and the implementation team. And then within that, the number of manager meetings that we do is quite phenomenal. The meetings with the fund managers that we use within the funds.
So, see, from the offices you have, you're pretty well located. Well, we know you're in Sydney, the head office in Seattle, and I know you're in London. What other jurisdictions are you in? Major jurisdictions for the amount of interest for the listeners?
So in the US, we have New York as well. Mm-hmm. We have a Toronto office in Canada. We have an office in Tokyo. We have an office in Shanghai. There are a couple of offices through Europe, so in Amsterdam and in France. Mm-hmm. There is an office in Dubai, mm-hmm. And the one in Sydney. We have a couple of employees in Melbourne as well.
Okay, so the reach you've got as a group, being located in all those different key areas, obviously is going to strengthen your knowledge and research of what's going on in those local markets.
Yeah, definitely. And the nice thing is that even though we are very geographically spread, the teams are quite tight. Even so, I speak to my boss is actually based in London, and two of my teammates are in Seattle. So it's quite regular to be on calls. Sometimes it's strange hours, but really trying to get what's going on the ground in different regions that we can then pass through across the organization. So even though we are very geographically spread, the flow of information is actually quite smooth.
It's interesting, when I went to the head office in Seattle a number of years ago, and I was speaking to the people there, we did a video, and I was asking about how they saw Australia, and we're talking about how we're very myopic and looking at our own markets. We invest in our local situation, where Australia only represents 2% of the world's share markets, and we don't have certain industries, or not large industries in some sectors as other countries have. So by investing internationally in these times, how do you see that's important as being part of the portfolio, Alex?
I think that having a regionally diversified portfolio is extremely important, because you can get access to those regions that are doing very strongly. For example, the US for the last 8 years, And you get those sector differences. So in Australia, you know, if you look at the Australian equity market, it's very much resources and banking. That's the big thing. You don't get as much exposure to tech or other different industries. And so I think having that ability to, you know, really get that different sector exposure and even just regional revenue exposure. We have a strong revenue exposure to China. But, you know, if we invest in European equities, we get some exposure to Germany and France that we wouldn't otherwise get with Australia. So I think that's, you know, coming back again, and it's just, you know, sorry to sound like a broken record, but the importance of diversification, and not just across asset classes, but within them, just ensuring that you have some exposure to different regions and different sectors.
Well, look, I think it's been very informative, Alex, to go through all these things with us today, and it's certainly, I'm hopeful that our listeners and my clients will be able to benefit from this information, just to reconfirm how important it is to be diversified and have an organisation like Russell, and there's others as well who provide a great service that we recommend for our clients to utilise. So I just want to thank you again for taking the time, and hopefully we'll be able to speak again towards the end of the year. So thanks again, Alex.
Thank you, Peter. Thanks for your time.
Okay, take care.
Bye.